After the annual general meeting debate over executive pay, Paul Little was in no mood to discuss the issue further with the media.
I'm not answering questions on remuneration. I think it's been dealt with extensively during the AGM, so I won't be answering questions on remuneration.
But there was a significant protest vote on it. Shouldn't you communicate that to your shareholders?
Which part of what I just said don't you understand?
In a non-binding resolution, investors holding 43% of the stock voted against Toll's remuneration report. Last financial year, Toll Holdings paid $55 million to its senior executives to buy out share options. Toll says the money was to compensate for its executives' forced disposal of any interests in Asciano when the port and rail business was spun out of Toll in 2007. But the proxy advisory firm Risk Metrics argues the deal was too generous by up to $35 million. It says the option payout assumed earnings per share growth of 24% per annum and a strong correlation between earnings and share price. Shareholder activist Stephen Mayne agrees.
Well, Paul Little should never have been given an $8.6 million cash payout as compensation for not having 484,000 options when the assumption was the share price was going to be north of $30.
And Toll could have saved shareholder funds by issuing shares to its executives rather than buying out the options with cash.
Well, this is the third substantial protest vote from institutional shareholders on this issue in 17 months. No other company has ever had a series of ongoing protests, and clearly the board still hasn't heeded the message, which is why now we'll clearly need some board change.
Last week, Asciano's chief, Mark Rosethorn, volunteered to forego $750,000 in short-term incentives to alleviate shareholder anger over Asciano's plunging share price. Stephen Mayne says that's an example Toll Holdings executives should follow or face potential legal action to recover the money.